They say hindsight is 20/20ths, but most traders don't use it. That's why 90% of traders lose money. They trade based on emotions and make decisions that are not objectively optimal. So what's the missing piece? Backtesting. It is the holy grail of trading because it allows you to simulate time travel. You can be an investing genius by doing this. Instead of relying on luck, you can improve your edge over the market by being smart. But here's the secret truth about backtesting. Backtesting is not just for geniuses. It's something anyone can do with a bit of guidance. And today you'll get that guidance, so sit back and let's go. First things first, what even is backtesting? In simple terms, it's running your strategy over past data to analyze how it would have performed. It's like a time machine for your trading strategy, but there's a big but. To get accurate results, you need to make realistic assumptions. If you make unrealistic assumptions, you're basically building a time machine that's powered by magic. No one wants that, so how do you make realistic assumptions? Well, keep watching and you'll find out. Next up, what tools can you use to perform backtesting? Well, luckily for you, we live in the age of technology where most of these tools are available for free. So here are 3 tools you can use. First, you can use TradingView Strategy Tester. This is a great option for beginners or those who want to quickly test basic strategies. Its interface is intuitive and easy to use. You can access it directly from the charts, which makes it convenient. Plus, it's relatively affordable compared to other options. However, it does have limitations. The historical data available might not always be the most detailed, and it might not be suitable for complex strategies. Some advanced features require a subscription. Additionally, it's mainly designed for technical analysis, which might not be enough for more sophisticated strategies. Second, you can use MetaTrader 4 or 5. Now, if you're already familiar with this platform for live trading, then you might appreciate the consistency. These platforms offer a wider range of indicators and allow for more customized backtesting. Whether you're into technical analysis, fundamental analysis, or a combination of both, MT4 and MT5 provide a good base for your testing. However, they are not without their own set of challenges. The learning curve for these platforms can be steep, especially if you're new to trading. And just like TradingView, some advanced features come at a cost. And you will need to spend some time learning the ropes. Third, you can leverage Python libraries such as Backtrader and Quant Connect. Now for the code geeks among us, this is the ultimate playground. With these tools you have the flexibility to build complex strategies and backtest them thoroughly. Libraries like NumPy, Matplotlib, and Pandas add to the power of these tools. However, if you're not comfortable with coding, then this option might seem daunting. It requires programming skills and familiarity with financial data manipulation. So now that you know the tools, let me walk you through the common mistakes to avoid when backtesting, so you don't end up with skewed results that make you think your strategy is a gold mine when it really isn't. Mistake number 1, curve fitting. What's that? It's like tailoring your strategy to fit perfectly to past market data. A little bit of customization is fine, but too much can make your strategy overfit. Think of it like learning from past exam papers. Studying only past papers won't help you in the actual exam. It's like trying to beat the market by simply copying its past moves. It might work for a while, but it's not sustainable. To avoid this, use techniques like the walk-forward analysis, where you divide your data into multiple segments and test your strategy on each segment independently. Mistake number 2, ignoring slippage. Slippage is the difference between the expected price of a trade and the actual price at which it executes. Think of it as the spread between the ask and bid prices. Ignoring it is like pretending you always get the exact price you want. But in reality, slippage can eat into your profits, so how do you account for it? Well, you can add a small random element to your simulated trades to represent slippage. Just remember to keep it realistic. Mistake number 3, using non-clean data. Raw data is like a treasure trove of insights, but if it's not clean, you're gonna have some serious issues. Non-clean data can lead to inaccurate backtest results. So how do you ensure your data is clean? Well, you need to process it. Remove any missing values, handle outliers, and ensure the data points are accurate. It's all about quality over quantity. Mistake number 4, not optimizing your backtest. Your backtest should be a living, breathing thing. You should continually refine it to make sure it's running smoothly. Regularly review and optimize your backtest. Look for areas where you can improve the efficiency or effectiveness of your code. Keep your code clean, well documented, and easily understandable. Alright, so now that we've got that out of the way, let's talk about how to backtest step by step. Here's a simple process to follow. Step number 1. Define your goals. What are you trying to achieve with your backtesting? Are you trying to maximize returns, minimize risks, or something else entirely? Once you know what you want to achieve, you can start to develop a strategy around it. Step number 2. Gather your data. Data everywhere. There are many sources of financial data out there. You just need to find ones that suit your needs. For example, if you're a fan of technical analysis, you may prefer to use tick data, which includes information about every trade executed in a security over a period of time. On the other hand, if you prefer a more high-level view, you may choose to use bar data, which summarizes price movements over specific periods like minutes, hours, or days. Whichever you choose, make sure it's clean and reliable. Step number 3. Test your strategy. Now it's time to put your strategy to the test. Run it over your past data and see how well it performs. This is where you can check your calculations, test different inputs, and tweak your approach. Don't forget to use a reliable backtesting software or tool. Step number 4. Evaluate your results. Take a close look at the outcomes of your backtest. Analyze the data, spot trends, calculate key metrics like the Sharpe ratio and maximum drawdown. This analysis will give you insights into your strategy's performance and potential areas for improvement. Don't hesitate to adjust your strategy based on these findings. Step number 5. Refine and repeat. Once you've evaluated your results, take the time to refine your backtest. Make any necessary adjustments and repeat the testing process until you're satisfied with the outcome. Remember, it's all about continuous improvement. So don't be afraid to experiment and learn from each iteration. Backtesting is like navigating through the financial markets. It's filled with twists and turns, opportunities, and challenges. By mastering the art of backtesting, you'll be able to navigate these markets with confidence. Remember, it's not just about finding the perfect strategy, it's about continuously refining your approach. So whether you're a seasoned trader or just starting out, embrace the journey of backtesting. Learn from each trade, each analysis, and each result. After all, it's not just a tool for trading, it's a path to financial mastery. That's it for today, folks. Thank you for joining us. And remember, if you found value in our content, hit that subscribe button. We've got plenty more where that came from, so until next time, happy backtesting and good luck in your trading journey.